All right. Good evening, everyone. Thanks for joining us. I'm Liz Holohan, Programs Director at Alumni Affairs. And on behalf of UC Santa Barbara alumni, I want to thank you all for joining us this evening for this July edition of our Gaucho Academy series, which is presented by American Pacific Mortgage. And I'm delighted to introduce Jason Matta, who will be leading tonight's home buying workshop. And without further ado, Jason, take it away.
All right. Thanks, Liz. Appreciate it. Good evening, everyone. Thank you so much for joining us on a busy summer evening. I'm sure, you guys have a lot of things you could be doing on a Wednesday night, but you're choosing to spend that precious time to be with us to learn a little bit more about home buying. So my promise is to make sure we educate you up with a lot of great tools and resources around home buying. As Liz mentioned, this is part of the Gaucho Academy. And so we're going to talk a little bit about home buying tonight. And this is a very interactive session that we present usually 4 times a year. So it's every quarter. We're going to record tonight's presentation. So you're going to have this available to you in a recorded version up on our YouTube channel tomorrow. And my colleague Ken will also send each of you that have signed up for tonight's class a copy of all of the slides from tonight. So you'll be able to kind of take some great notes tonight, but also have these resources shared back out with you. In case you haven't heard of our organization, I work for a company called American Pacific Mortgage, or APM. We're a nationwide lender. So I am a mortgage lender in all across the country. We're the ninth largest lender, and I happen to be one of the top providers in financing across the country. We really specialize in first-time home buying. So we utilize our educational platform, like you're being a part of tonight, to help educate our communities on affordable home ownership, not just from a first-time buying perspective, but also just really how do we put in place tools and resources to help support you on really what's going to be probably the largest financial decision you decide to make at some point in time, right? And so we provide classes like this throughout the country to help train you up on what home buying can look like for you. Again, this is a very interactive session. So as we go through tonight's talking points, I would encourage you to ask questions of us. So you can use the Q&A function within Zoom. You can also use the chat function. I'll be monitoring both areas tonight, and then I'll try to answer some of those questions live on air. And then we'll also carve out some time later on in tonight's class in case you do have any follow-up questions. We'll make sure we get those answered before the end of the session. Now, our runtime is going to take us up just to about the top of the hour. In tonight's class, here's what we're going to discover a little bit. We're going to first talk a little bit about the housing market, kind of what's going on collectively across the market. We are going to kind of generally focus on the California or Southern California markets. We'll also spend some time talking a little bit about interest rates and what's happening there. Got some kind of updated news based upon some Federal Reserve meeting minutes that came out today. We do want to walk through a buying exercise for you when it comes to budgeting for homeownership. So I'm going to share with you one of our really cool calculators that's available to you that you can kind of figure out how do I set myself up to compare renting and doing that continuously for X amount of years versus what could it look like if I continue on that same path, but on a mortgage side of things. We'll also want to give you some tips around credit, some resources that are available to you, outline some various loan programs, talk a little bit about savings for home ownership that can be a pretty big challenge for most home buyers. So we're going to walk you through a savings plan to help equip you on the right resources you'll need for first-time home buying. Speaking of first-time home buying, we'll talk about assistance programs that are available in California. And I want to walk you through the buying process. So after you leave tonight's class, hopefully you have a lot of great takeaways for yourself. But if you're looking to be on that path towards homeownership, I want to give you some of the milestones that you're going to experience as a future buyer. And I want to kind of just share with you how you can get connected with us for a consultation after tonight's class. All right. So that's our journey for tonight in this next, 55 minutes or so. Glad you're along for the ride, and we plan to give you a lot of great information that you can take away tonight. Well, as we mentioned, as we launch tonight's class, it's a busy time of the year, right? It's a busy week, right? It's a busy Wednesday summer evening. I do appreciate you being part of our discussion because this is a big decision for you financially. It's probably going to be one of the largest decisions you decide to make in buying a home. And there's a variety of different elements to consider in home buying that make up some of the benefits for home ownership. One is, especially around affordability in today's market, you have the opportunity to control your budget when you're a homeowner. You're not worried about the landlord increasing rent on an annual basis when you renew your rent. And so when you look at home buying, also in today's market, rates are at elevated levels, but many of our buyers that are buying in 2025 are going to have opportunities to refinance or lower their interest rate in the next year or two as rates start to normalize. And we'll dive a little bit deeper into our rate discussion. And this is an asset that will grow over time. For most of us, it's probably our number one asset in our portfolio for us that are homeowners. That home should hopefully appreciate over time. So if I buy my house for $500,000 and it appreciates to 700,000, and now I only owe 400,000 on my home, that's $300,000 in real equity and assets that I have available to myself. And there's some tax benefits that also come along with owning a home, potential tax deductibility of interest, as well as when I choose to make energy efficient upgrades to my home, I can also benefit from that as well. So a lot of great things that can come along with home ownership. So when we think about home ownership, I would say it's not necessarily like an apples to apples comparison because even though I'm paying $3,500 a month in rent, that doesn't necessarily translate to $3,500 in mortgage expense. Now, to illustrate that point, I just switched our screen share to one of our calculators that are available to you. It's our rent versus buying calculator, and that essentially kind of frames up for you that side-by-side comparison of owning a home over the next X amount of years versus if I want to continue to still rent, what's that going to do for me, right? And so this is that tool that you can dive into when you have a free moment, but I just want to walk you through some of the components of this. And so when you utilize a calculator like this, you're going to look at, what type of price home am I going to look at? So in this scenario, we have 700,000. We have a 3% minimum down payment, which we'll talk more about in our program segment. So essentially, I would be financing $679,000. We have our average interest rate, and then of course a 30-year fixed mortgage. This also assumes that I'm going to buy my house in July, since we're having this discussion in the month of July. We also include in that calculation mortgage insurance, which we'll talk about tonight, which is also known as PMI, the cost of homeowners insurance, which varies based upon where I'm going to buy, property taxes. All of those things are part of the characteristics of homeownership, right? And then the benefit side of things include like tax benefits that we have in owning a home, the appreciation rate of my home. And then I compare that with a rental side of things, right? So in our scenario here, we have someone that's paying $3,000 a month in rent, but they're choosing to buy a $700,000 home. They have appreciation or cost increase in rents, and then the cost of renter's insurance that gets put in this calculation. So these are all form fillable. So we would encourage you to put your own maybe data points in there and you can walk through this exercise. And so ultimately, what our calculator kind of tells us is that if we choose to essentially buy a home versus continuing to rent what I'm doing right now, after 5 years is really kind of when I hit my break even, when I start making money as a homeowner versus renting. And so I kind of push this out and you can see this kind of the break even here at 5 years. So that essentially means to me is that the investments that I make in homeownership versus what I'm going to outlay in renting, I'm going to break even in a 5-year span of time, right? And so when I look at my net spend over 9 years, my opportunity of owning versus renting is about an $85,000 opportunity because that equity stacks, right? So it continues to appreciate year over year. And so that is truly where we have to think more about homeownership when it comes to comparing our budgets, because ultimately it might be a stretch for some of us to purchase today, but we have that opportunity of appreciation year over year. We're going to talk a little bit about the housing market in just a second, but this kind of gives you some basic framework for how we should think about comparing renting versus owning. I did have a question in the chat about the link. Yes, we will send the link to you so you can have that. That'll be part of our deck page that goes out to you tomorrow. So we'll make sure you get that as well. And then you can take some time to dive into that exercise yourself. I think you'll find that to be a really helpful tool in kind of preparing yourself for home ownership. You're going to hear me talk also a little bit about consultations tonight that we do free of charge for clients across our communities we serve. We could also spend some time walking through that exercise together. All right. Now let's talk a little bit about the housing market. There's a lot going on obviously in our world today, but specifically to our housing market, we're in kind of an interesting time right now. In some regards, I would see our housing market maybe pivoting a little bit from a seller's market, which we've seen since the pandemic, Two, in some markets, really a buyer's market. You can see some homes staying on the market upwards of 2 months in some parts of California. Collectively across California, we have a days on market just over a full month, which we haven't seen in a long time. The market is a lot different than we've seen certainly over the last 2 years. So there's more inventory available to buyers, and sellers are starting to make some price corrections. In case you didn't know this, 44% of all transactions being done across the country have some type of seller concession on them. That means the seller has conceded like credits that can help a buyer when it comes to closing costs for their home. Also, we're seeing some price reductions out there as well. Now, California is still a very strong housing market, but if you look in markets like Colorado, you look in Georgia, Florida, Texas, we're seeing a really big backlog of inventory in those markets. Certainly, those markets have flipped to more of buyers' markets. So I think that where we stand in today's market, while we're at higher than expected interest rates, there does possess some opportunities for buyers in today's market. Because as I mentioned, we were thinking about, does buying make sense for me? Some buyers that choose to get into today's market, while we might be at elevated interest rates, will have the opportunity to potentially refinance in a year, maybe 2 years down the road when things start to normalize a little bit. So I think there is some really good news on the horizon with our housing market. Now, let's step back for a second. Affordability still remains challenging, right, for all of us across the country. So it doesn't, change that. But I think if you compare it year over year for what we've seen in the market, we are starting to see some changes develop in the housing market that do benefit buyers. Not major price corrections, but at least supply that can help support buyers' demands in the market. And as interest rates change, and eventually interest rates will change, buyer demand always increases. Okay, so we have a huge pent up demand of buyers that just for some reason can't, not for some reason, but for a big reason of interest rates, can't afford to enter today's market. So let's talk a little bit about today's market of interest rates. It does remain a very volatile market in interest rates. We are currently at elevated interest rates because of the Federal Reserve trying to control what's going on with inflation. The Federal Reserve has an elevated federal funds rate, which is at that level to help combat inflation. The inflation goal for the Federal Reserve is 2%. So we have two mandates by the Federal Reserve: hit 2% inflation, and then we're looking for any signs in changes in the labor markets. Now, the Federal Reserve is getting a lot of pressure right now from the administration to try to lower rates, and we still haven't seen any action on interest rate reduction. Two of the Federal Reserve managers agreed to potentially lower rates in July. We still haven't seen, or maybe gave indication they would support rates lowering in July. Haven't seen any indication at the next meeting that will be happening, but we will see rates probably go lower in the latter part of 2025. But we still kind of remain in kind of a choppy market, still trying to figure out what's the impact of tariffs on the economy. Are we going to see cost of goods increase? Obviously, we're still in a pretty high inflationary environment, even though we've seen inflation cool in the most recent reporting. Now, in today's interest rate environment, interest rates are about 6.7 to 6.8%, depending on what day you're looking at. We had a nice little improvement in interest rates today based upon some of that commentary from the Federal Reserve. We'll see if we can get some traction on that. We are really watching closely the 10-year Treasury note. For those of you that kind of pay close attention to what's going on in the economy, 10-year Treasury lifted over 4.4 to about 4.43%. Today, we saw it slide back down to about 4.31. I think it was the lowest levels we reached in today's trading days. Now, these interest rates aren't a lot different than we saw 20 years ago, but keep in mind, 20 years ago, home prices were a fraction of what they are today. This 20-year snapshot shows you kind of what interest rates have looked like over the course of 20 years. And I want to bring this to your attention because one of the questions I get often is, when are we going to return to 2.5% interest rate levels, which we saw here, right? Well, the reality is we're probably never going to return to those levels, and hopefully we never do, right? Because that means something catastrophic has happened. That 2.5% rate was the lowest rate we've ever seen historically in interest rates. The norm on interest rates is right around the high fours to low fives. And, we'll eventually make our return to that level. We can see, right around here in the 2010 level years. We saw that a little bit in 2018. So we will get the return of that. It just will take time, and inflation is going to have to cooperate that for the Federal Reserve to make moves on the federal funds rate. So we had a question in the chat as we kind of move along and talk a little bit about credit and what makes up interest rates is, can people refinance whenever they want to? Are there restrictions against doing so? So generally, there are no restrictions in refinancing of a home. Sometimes within first-time buyer programs, they may put restrictions on certain improvements of interest rates to make sense out of refinancing. Also, if you purchase in, say, an affordable housing community, like a below market community, there might be some restrictions on that. But generally, there are no restrictions on refinancing. But there is a calculus in terms of the make sense of refinancing. So if I bought my home today at, let's say, 6.75% rate, generally I'm going to want to see at least a 1% reduction in rate based upon the market conditions to warrant me making a move and doing a refinance. The reason why that is because we want to make sure we can recoup the cost that it's going to take to refinance my home in at least 10 to 12 months to have a make sense in refinancing. So many of our clients that have refinanced in the last 2 years, frankly, it hasn't made sense to refinance, right? But as those clients that bought maybe 2 years ago at 7.5% interest rate levels, now they're starting to have their ears perk up a little bit that, hey, maybe there's going to be an opportunity to refinance in the latter part of this year. So obviously, we're watching out for our clients in that. Now, interest rates are not the same for everyone. It does vary on a few different factors. One is credit score and the eligibility for a specific program, the type of loan program I'm going to do, how much I decide to finance, what my down payment looks like. And then you do have the option as a consumer to pay what we call as discount points, where essentially you pay more money out of pocket in order to bring down your interest rate. Usually, 1 point is going to be the equivalent of 1% of my loan amount, and that translates to about a 0.25% reduction in interest rate. Well, you've heard me mention a little bit about refinancing in a year or two down the road for most of our existing clients. And given that approach, I really wouldn't recommend clients pay discount points because there just isn't a good return on investment in this today's market for those type of costs. Now, loan term can also reduce my interest rate. So the shorter my loan term is, generally that will give me also a lower interest rate. Now, we get a chance to meet with our clients throughout the country and the communities that we serve and design some different options for them. And we'll do the same thing for you. Whenever you decide to take that path towards home ownership, we're going to figure out which product makes the most sense for you. All right. Now, credit is one of those elements that go into interest rate, and that obviously can drive our borrowing costs. And so, as part of our workshop, we always like to kind of dive into credit and give you some tools and tips on what credit can look like for you and to help have you prepared for home ownership. And I think it's important to understand that every program has a minimum credit score that's a tie to it. We've spotlighted some of those programs on screen that you can see here with the FHA, conventional VA, and some of the first-time buyer programs. That's California Housing Finance Products. We're going to spend some time looking at the guidelines for those programs, but I just want to give you the minimum score so you can have a picture of that. Now, when we think about credit, there are three different agencies that report, right? There's TransUnion, Experian, and Equifax. All three of those agencies have different risk models, so you're going to get three different scores. There's also three different models to scoring. There's credit card, there's auto financing, and there's the mortgage model. Now, of course, when you're applying for home financing, we're going to use the mortgage model. So if you've checked your credit maybe before tonight's class and Credit Karma is telling you you're at 750, well, if you got your mortgage score pulled, it might be 760 or 740. It's just because the weighting of the credit score is different in the mortgage model versus the consumer credit card model that you see in some of those monitoring services. Bigger items that hit your score like late payments, over limits, credit inquiries, hard inquiries, those are going to have impact to your score within the most recent 12 to 24 months on your scoring. So, if I'm meeting with a client and they've had a late payment back in October of 2024, they're still inside of that 12-month period. So they're probably having a bigger impact to my score, to their score. But as they move further and further away from that date of that late last payment, they're probably going to see some organic lift in their credit score. Now, in lending with all three of those scores, we always take the middle score of all three agencies. So if my top score is 760, let's say my middle score is 740, my lowest score is 720, we're going to take the 740 score when it comes to qualifying for home financing. Now, that's if I'm applying by myself. But let's say my partner is also going to apply. My partner's at 740, 700, and 680. Well, my partner's middle score is 700, which is lower than my mid score of 740. So in that scenario, for qualifying purposes and for interest rate options, that 700 score is what's going to be used for qualifying. So that's really important to understand because as we design home buying options for our clients, we're going to figure out like what's the right approach to building your financing given some of the aspects of credit. Now, when we look at a credit report, this is a matrix that's going to show you how long any type of challenges or negative items will remain with you on your credit report. In fact, I met with a client earlier today. they have a student loan payment that was late pretty significantly back in December of 2018. Well, per this matrix, that late payment's going to stay until 2025 of December. But then in January, they'll see organic lift on their score because that late payment would actually fall off of their credit report. Now, it's not going to if you have a late payment, for example, when that removes from your credit report, that's when you're going to get the lift. The really big impact is going to be in the most recent 12 to 24 months from the date that that original late payment occurred. So over time, as we get further away from negative items, they will organically get a lift in our credit score. Now, here's what the mortgage score calculation looks like when it comes to looking at the modeling for credit. So I'm going to walk you through just kind of each one of these areas because you'll probably have a bit of an aha, like, okay, that's something I can kind of maybe figure out on my credit report because maybe that's where I'm lacking today to get my optimal level of score. So 15% is going to be how long I've had credit. So the longer my credit profile is, the higher my credit score is going to be. 20% is going to be looked at how much new credit am I trying to open? So if I'm trying to open up a lot of new accounts, especially in a short period of time, like 6 to 12 months, I'm probably going to have a negative impact to my score. That also centers around inquiries of credit. So if you're having someone do a lot of different inquiries on your credit, it can also impact your score. And we're speaking specifically to hard inquiries. Now, one of the things to note in our process with clients, when I work with a client one-on-one, we only start with a soft credit check. And the reason why we do that is because a soft credit inquiry does not impact your score, whereas a hard inquiry does. And the reason why we choose to do that is because many of our clients are, probably looking a year, maybe even 2 years out. And so as we build their home buying plans, we want to give them options for home buying, but not necessarily impacting their credit score. Now, last thing I want to touch on in this area is there's a rule in credit scoring that if you apply for auto financing, for example, or even mortgage financing, and they do a hard inquiry, then you have a 30-day window of time to shop around with as many lenders as you want, but you have to keep it within that 30-day window of time. All right, 30% is going to be around credit utilization, specifically revolving accounts. We're looking at balances versus credit limit ratios. Now, to give you an example, if you have $10,000 in limits and you have a $5,000 balance, right now I'm at 50% utilization of credit. Now, if we're trying to really improve our credit score, ideally we want to push those balances to 10% or $1,000 or less. That's when we're going to be able to really optimize credit score. Now, each of your credit cards report out your status, balance, history, all that stuff to the agencies on the billing cycle date. So here's one of my tips for class tonight. If you can try to pay down your credit card before the end of the billing cycle, so if my billing cycle is on the 20th of July and I pay off my credit card before the 20th, then that's going to report that zero balance to the credit agencies, therefore giving me a lower balance, more credit availability, and improving my credit score. So oftentimes some clients will pay on their due date, which if my due date's on the 5th, but my cycle closes on the 20th, if I'm paying on the 5th, it's kind of too late because now the credit agencies have already picked up my balances. So if I can pay that off before I close out my activity, that's when I'm going to have that improvement in credit score. Last thing in the weighting is payment history. So that's simply how have I paid my bills. So if I've had a late payment, just like I gave you that scenario earlier, if I had a 30-day late on my student loan back in 2017, that's going to have that impact in that 35% range. After 7 years, it falls off, but especially in the most recent 12 to 24 months, that's when I'm going to see the impact to my credit score. All right, so that kind of gives you an idea of the mortgage score weighting. Again, there's 3 different risk reports. There's a credit card score, there's auto, and then there's mortgage. All right. So we're going to talk a little bit about student loans because that kind of stays within the theme of credit because student loans obviously appear on credit. We're starting to see some student loans start to come back online in payments. And I know some of us are probably still working through maybe forgiveness of student loan debt. Or maybe we're back in school because we're on a deferment program. Maybe we're still in forbearance, whatever like stage you're in. When it comes to mortgage financing, if you're going to apply today, we do have to count a minimum payment when it comes to qualifying for your mortgage. Now, if you're currently in an income-based repayment amount and you owe $75,000 in student loan debt and you're paying $250 per month, we can use that payment right away for qualifying purposes. Okay. But if you're in forbearance, you're in deferment, or you're still waiting for forgiveness of debt, then depending on the program type, then we have to assess a minimum payment based upon that particular program guideline. So if I'm going to apply for a FHA loan, it's going to be 0.5% of those balances, and therefore I have to qualify with a 375 payment. Or if it's a conventional loan, it's 1% of the aggregate balances, and that's a 750 payment. So the important takeaway here in the student loan section is it really depends on what stage you're in. Just because your student loans don't have active repayment, when it comes to qualifying for a mortgage, we still have to count a minimum payment into the expenses for your qualifying mortgage. All right. Before I dive into some high level look at some of the program parameters or guidelines, I just want to take a quick little pause. Do we have any questions from the audience? I see some of us joining in the class here, catching up. For those of you that just joined class, again, we're recording tonight's class, and we're also going to send out the presentation material. So if you missed some of my earlier comments, that'll be up and recorded up on our YouTube channel tomorrow. So you can certainly catch up and scroll through the earlier comments. Again, if you have any questions too, you can use the chat in the Q&A function as well too. We'll get those questions answered. Let's talk a little bit about loan programs, and I just want to spotlight 5 programs for you to kind of think about. I will say these two programs, conventional FHA, are going to be the most popular programs. Conventional loans are about 60% of all originated loans across the country. When we think about conventional loans, that centers around Fannie Mae, Freddie Mac agency loans. Now, you're probably seeing Fannie Mae and Freddie Mac in the news recently because they're talking about privatizing Fannie Mae and Freddie Mac, which who knows what that could do to the housing market. But Fannie Mae and Freddie Mac also had a lot of spotlight during the housing crisis. So they basically were taken under conservatorship by the US government. Now they're pretty financially stable. And so we'll see what they decide to do with Fannie and Freddie. But ultimately, with their program guidelines, you have a minimum down payment of 3% as a first-time buyer, does have a minimum credit score of 620. And then FHFA sets a conforming loan limit every year. So this year in 2025, it's 802,650, but that number does change every year based upon cost of living. And then we have the FHA loan. That stands for the Federal Housing Administration. You may have also seen FHA in the news recently with some changes around government insured loans. So both FHA and USDA are both government insured loans. The changes made, which were obviously challenging to work through around changes of residency status. So unfortunately, non-permanent residents cannot have access to a government insured product. Conventional loans, Fannie Mae, Freddie Mac still allow non-permanent residents to qualify, but unfortunately, with government insured loans, non-permanent residents do not have access to that product. On an FHA loan, it is a government insured product. There are 2 forms of mortgage insurance, which we're going to talk about in just a second. It does have a 3.5% down payment, minimum credit score of 580, and the maximum loan amount is 763,600. But that does really vary by county that you're going to buy in. And then since we're talking about government insured loans, let's talk more about the USDA loan. That is a loan designed to support rural area purchases. So there's 2 qualifiers to USDA. They take a look at income as your household goes, and then it has to fit in a USDA designed area as a rural area. Minimum credit score of 620. You can see the loan amount there. That also does vary by location. The jumbo loan is going to be for clients that need to buy with a little bit more buying power, need to finance a little bit higher of a loan amount, but it does come with it higher or more stricter guidelines, 10 to 15% minimum down payment, minimum credit score usually around 700. And it's essentially for clients that are going to buy higher than some of the agency limit products. Now, I didn't mention to you that in our high cost of living areas, and so for those of you that are in Ventura County or you're in LA County, Orange County, even the Bay Area markets, there is what we call high cost of living areas where this loan amount can go up to as high as $1.2 million. And so that supports higher purchase price transactions. However, the minimum down payment when we go above 802,650 goes from 3% to 5%. So we call that a high balance loan. Last loan, which is an incredible loan for our veterans, is the VA home loan. So if we have veterans in class today that are looking to purchase using the VA home loan, it's a 0 down payment option. There really is no loan amount limit for the VA product, 620 minimum credit score. And then depending on the status of the veteran, if they're receiving any type of partial disability, then there is an option for them to have their funding fee, it's a VA funding fee, completely waived. Okay. All right. And so that's a kind of a quick look at products. And we actually do have a little footnote here on the high balance limit. So that takes us up to 1.209750 in total loan amount for high cost of living areas. All right. So you may have heard around mortgage insurance and maybe some of the misinformation out there around mortgage insurance. So I want to kind of just share with our class a little bit more around mortgage insurance. So there's two different areas of mortgage insurance. There's PMI, which is private mortgage insurance, and then there's government mortgage insurance. So PMI stands for private mortgage insurance. There's about 7 or 8 private mortgage insurance companies that essentially insure lenders against maybe default by the buyer. So if the buyer has a struggle making their payments, then the mortgage insurance would be able to support the buyer. Now, it's essentially based upon risk. So the payment that you pay as a consumer changes based upon down payment, credit score, and how much you finance. So the more I put down, the higher my credit score is, the lesser cost I'm going to pay from a mortgage insurance perspective. Now, if you've done some searches in home buying on Redfin or Zillow, and maybe you've decided to dive into some of their calculators, what I found in consulting with clients is those calculators aren't super accurate because they don't really calibrate to what we see here in the risk factors for PMI. So we'd encourage you to talk with us a little bit more about your particular scenario because we'll be able to figure out exactly what your PMI calculations look like. Now, one of the benefits of a conventional loan is PMI has a cancellation option that once I reach 20 to 22% equity and I have 2 years in my loan, I can apply to have that mortgage insurance canceled. So let's look at a calculation of mortgage insurance. So if I bought a 700,000 or I financed $700,000 and I put down 3% and I have about a 740 credit score, my mortgage insurance cost is just over $200 a month. So it is still reasonable when you look at private mortgage insurance, and those costs will lessen as I lift my credit score, as I increase my monthly down payment. Now, the other product we want to compare that to is the FHA home loan. So FHA, again, stands for the Federal Housing Administration. That is a government insured loan. There are two forms of mortgage insurance, which makes this product look a little bit different. There's upfront mortgage insurance, which is 1.75% of my loan amount. And then we factor that into the total amount financed. And then there's monthly mortgage insurance, which is 0.55% of my loan amount. And then I divide that by 12. And that's how I come up with a dollar figure on a monthly basis. Now, with FHA mortgage insurance, it can only be essentially removed is when I refinance out of the FHA loan into more of a conventional home loan product. Now, the FHA loan, from my perspective, is going to be the entry point for our buyers into home ownership. We look towards the FHA product when maybe a client has had past challenges, maybe they're a little bit overextended in debt. FHA is going to give us a little bit more flexibility in underwriting guidelines as we compare that to more of a conventional home loan product. Now, if we take the same $700,000 loan amount, we now enter the points for FHA. We have upfront mortgage insurance that's going to get added on of $12,250. That gets included into my total amount finance. And then the mortgage insurance is going to be higher. It's $320 per month. So, the cost structure is going to be higher on an FHA loan, but to my point earlier, it is going to add a little bit more leniency or flexibility when it comes to qualifying for your home financing. All right. Let's talk a little bit about qualifying income. And so we're going to kind of dive a little bit deeper into building our home buying plan. And when we think about qualifying income, we're going to have a discussion around employment and some of the requirements, if you will, when you're looking to pursue home ownership. Now, before we do that, I do want to give you some of the documentation that we generally ask for when it comes to qualifying. So this is some of the basic document checklist. So as you're considering consulting with us for home ownership, this is generally what we would ask for. Now, from an employment perspective, I want to kind of share with you what a lender generally looks at. So we usually look at the last 2 years of work history and residential history. Residential history, that's pretty easy. You don't necessarily have to be renting. You could be living at home for the last 2 years, totally fine. But when we verify employment history for the last 2 years, that can also include educational history. So if you just started your job last month, all right, but you graduated from UCSB in the fall, we can use that undergrad history to count towards your work history as long as it connects to what you're doing for work today, right? And so that can be something that can help you get you into home ownership, because oftentimes clients will call me and say, Jason, I'd love to buy a house, but I've only been on my job for a year. But when we factor in educational history or even previous job history, that client might be able to buy a lot sooner than they expected. Even in scenarios where we're looking to graduate in, this next year, right? Or maybe we're making a transition in job, but we already have an offer letter for a job. As long as that is a non-conditional offer letter, we can use that for qualifying right away. So, many times clients will think they have to have this 2-year history of being on the job, which just really isn't the case. So we can figure out ways to basically build a 2-year history along with having a better understanding of what that new projected rent income looks like. Last thing I want to kind of touch on here when it comes to the 2-year work history is just looking at job transition. So if I'm working for one company here for the last 6 months and I'm going to make a switch to a different job because it's a better paying situation, I can qualify for my mortgage with that new pay history as long as I have a documented start date and I can show that verified offer letter. Now, when it comes to looking at dual employment, that looks a little bit different. So if I work for two different employers and I want to count both sources of income, then I have to show that I've been on both jobs simultaneously for the last 2 years in order to count that income. If I'm self-employed, it's a little bit different because now I have to show that I have 2 years of tax filing. So if I'm an independent contractor and I get 1099s or I open my own S Corp or C Corp or LLC, we do have to show 2 years of tax filings. Okay. Last thing we'll touch on here, and then we'll keep things moving, is any type of additional or ancillary income sources that I want to introduce to my qualifying all have to be documented. So for example, if I have a partner that's not going to be part of my application, but they contribute to the household income and expenses, I can't introduce that income unless that person is going to be part of the loan application. And in some cases, we also have clients that maybe receive room rents for maybe a roommate that they have in the place. Even though that's income that they see today, generally for most products, that income can't be transitioned over to the home purchase qualifying. All right. One thing that comes up quite often, and just because I had a conversation with a client in one of our East Coast markets earlier today around job relocation. If you're a lot of clients obviously work hybrid today or fully remote or, a couple days in office. We get a lot of questions around that. So if you have a reasonable commute distance, you can buy, an hour and a half, hour 45 away from, your job location. That is completely reasonable. If you're in a remote position and you're going to, if your employment is on the other side of the country and you're going to, live in Santa Barbara, we have to document that you're fully remote. So that question comes up a lot. It's obviously come up a lot since the pandemic because more people work from home. But as long as we can document remote status, that is not an issue in terms of location. All right, question came in the chat, which is, does employment history have to be the same job with the same company, or it can be in the same field? So it just has to be in the same industry generally. It doesn't have to be the same company. So yeah, that's a good question. So you can make a job transition. Where we have to kind of talk through it a little bit more is compensation packages, right? So if you're working on a base salary position plus maybe bonuses, if I want to include bonuses into my calculation, then I have to demonstrate a 2-year same job history to be able to count 2 years of bonuses because we average the last 2 years of bonuses. So if you're going to go switch jobs and that has a bonus component to it, generally that new job variable compensation of bonus wouldn't be able to be counted, just your base salary. All right, thanks for that question. So we tie income back to expenses too. So we walk you through what we call a debt to income ratio calculation as part of our consultation. So we're going to compare what do you have for outgoing expenses today, like credit cards, personal loans, student loans, any debts that generally will appear on your credit, along with the new housing payment, the principal and interest. You can see here taxes, insurance, maybe PMI if I'm putting less than 20% down, homeowners association dues if I'm buying a townhouse. And then we compare that versus your pre-tax income. So if we have a real-time example of looking at this scenario here, we have a $2,500 mortgage payment. We have a client that's spending $500 a month in debts, and they make $8,500 in pre-tax income. So what that calculation of debt to income ratio tells us is that client has 35% of their expenses being, 35% of their income being consumed by expenses. So generally, from a guidelines perspective, we wouldn't want that to exceed more than 45 to 50%. the question I get from my clients as we work with them is that, what's the kind of the comfort level or the optimal level? I would say somewhere between 33 to 36% is going to be really strong for most clients. It is going to tie back to really what your comfort level is from an affordability perspective. As we build home buying plans for clients, our two big goals is your comfort level with the affordability, right? And we also want to make sure this is a sustainable home buying plan for you. So if things change for you economically, you're still able to support yourself in really thrive in home ownership. All right, so we talked a little bit about income versus expenses. That's the debt to income ratio calculation. Now we kind of want to turn the corner and talk a little bit about savings for home ownership and what down payments look like. You learned a little bit about the minimum down payments for qualifying for a mortgage. Now let's see how that kind of translates into what we have to have in resources. Now we do have to document the resources that you're going to pull together for home ownership. That could be via checking and savings account, could be brokerage accounts, 401ks, 403bs. If you're going to tap into any type of investments, I would encourage you to talk to your financial advisor or tax advisor before accessing those type of investment accounts, because we don't want to create any tax liability or any type of penalties for yourself. Now, as you can see on screen, gift funds can be allowed in a home purchase. That's where a family member is contributing towards your home purchase. Assets do need to have a 60-day seasoning requirement. However, when a family member is gifting you funds towards your home purchase, there is no seasoning requirement. We just have to paper trail all of the assets used in a home purchase. All right. And oftentimes, family members do contribute to home purchases, so it's not out of the ordinary for a family member to help support a first-time home buyer. Now, as we think about home ownership and prepare with savings, honestly, for most clients, savings is the biggest challenge. Now, we're going to talk about assistance programs in just a few minutes, but before we do that, I want to give you a simple approach to savings that could really help on this path towards home ownership. And it looks a little bit like this. So let's say I'm paying $2,000 a month in rent, right? But after consulting with me for your home ownership plan, our projected mortgage payment looks about $3,500 a month, right? So that's a bit of an increase from where I'm at today, but my income can support it. It's just the challenge of saving up for home ownership. So what my approach would be in coaching with our client is to say, hey, let's start saving today like I'm making that $3,500 mortgage payment. So on the first of the month, I pay that $2,000 a month rent, right? But I create that discipline that I take the extra $1,500 that I know I can afford for my mortgage one day. Let's get that transferred into my savings account on a monthly basis. By the end of 6 months, now I've accrued $9,000 in savings. By the end of the year, I got $18,000 in savings. And we're not including any type of high yield accounts that provide 2 to 3% interest. So that's an approach to savings, I think, super simple, but very effective. And it really helps, chart that course for our first-time buyers towards home ownership. So that's an approach to savings, kind of essentially paying your rent like you're actually making that mortgage payment today, right? And as we talked a little bit about in the benefits of buying, there's tax deductibility benefits that come along with home ownership that I don't realize today as a renter. So even though I'm increasing that payment from $2,000 to $3,500 a month, I'm still realizing some really great benefits that come along with home ownership. All right, let's talk a little bit about assistance programs, then we'll talk about workflow, and then we'll wrap up tonight's class. I did get a question in the chat before we go over to assistance programs. That is around, and I'll just kind of go through this. Let me scroll back up here. So you mentioned that bonuses are averaged over 2 years. How are RSUs treated, especially when different companies have different vesting schedules? For example, my current RSUs have a 6-month cliff, so I won't receive anything until then. So good question. So RSUs can be used in the calculation for income for qualifying. So those can be factored in. So generally you have to have beyond your job that you're receiving the RSUs from, so that employer, for at least 2 years. The way we assess those RSUs is we look at the average price of the stock over 3 years, and we take that average stock price times the number of vested shares, and we divide that over by, I believe, 24 months to create an income stream if you want to use RSUs as income. Of course, if you have vested shares of RSUs that are accessible to you, you can cash out those RSUs and certainly use those for contributions for your down payment. Okay, so if you have a specific example that you want me to kind of walk through, we can certainly talk about that offline for sure. And then question was, funds must be seasoned in account for 60 days. Does this include funds transferred from the sale of stock? into a savings account. So when we think about seasoning of funds, we just have to see the paper trail of those funds. So if you sold shares of stocks, they went into a cash account, we can see the movement of those funds. And long as you've had that stock for at least 60 days, then we meet the seasoning requirement. We're really kind of spotlighting more cash deposits that are made. So we can't just have unsourced cash enter an account and try to use that for a real estate transaction. All funds in a transaction have to be looked at for the Patriot Act to make sure we have compliance with that. All right, good questions from the class. Appreciate that. Okay, so let's talk about assistance programs. We'll walk through this fairly quickly, but then we'll spend some time talking about the process and get you guys to the finish line tonight. So let's talk about assistance programs. So most of us are in California, and so there are support mechanisms for both low to moderate income households. A low income housing household is someone that makes less than 80% of the median income in your respective county. And then moderate income in the eyes of CalHFA is up to 150% of the median income. So we're proud to be the #1 partner of CalHFA in the state. So we transact the most number of first-time buyer programs in the state. And the reason why is because I'm really passionate about serving my community in affordable homeownership. And these programs can certainly help you with that. So there's a variety of different resources available to you in the state. So the main program is the MyHome Assistance Program, which will essentially provide that 3% minimum that you need for a conventional loan. On an FHA loan, it's 3.5%. Essentially is a separate loan that we create for you at a 1% simple interest rate. And those funds are not required to be repaid until you either sell the home or if you decide to refinance the property in the future. Now, so that can provide resources for the minimum down payment. Now, if a first-time buyer needs more resources, there's the My Access program or even the ZIP program. Those programs are kind of interchangeable. They will bolt on to the My Home Assistance Program. They're generally used to pay towards closing costs or prepaid items to help reduce down the out-of-pocket for a buyer. My Access is a 1% simple interest rate loan. The ZIP Assistance Program is a 0% interest rate loan, both deferred payment options. The big thing with those programs is they are interchangeable. They will change the first mortgage rate depending on if you add those to the My Home Assistance Program. But the other big benefit with first-time buyer programs is the first mortgage rate generally is a little bit lower than the market rate, especially for buyers that are putting less than, say, 20% down on a first mortgage product. Another product just to spotlight for you is the Pathway DPA program. Does not have an income limit restriction to it, like say CalHFA, but it does allow first-time buyers to get 3.5% to 5% of their sales price in assistance on an FHA loan. You may have heard about the GSFA or Golden State Finance Authority program. That could be a really good program too. I would probably look at it as an alternative option for some of our clients that don't necessarily qualify for CalHFA because it doesn't have a deferred payment option on the assistance. And for those of us that may qualify as low income or we call very low income housing options, so that'd be below 60%, Fannie Mae and Freddie Mac, who you learned a little bit about tonight, also has some incentives for some of those buyers. Now, if we were to overlay, say, this assistance program into say, a conventional home purchase scenario, let me first show you what a traditional conventional home loan purchase would look like out of pocket. So if I bought a $700,000 home, I'm putting a minimum of 3% down. And we think about closing costs to buy a home. And we haven't talked too much about that tonight, but closing costs are things like title fees, escrow fees, some of the local transfer taxes in your market that you're going to buy in. Whatever essentially gets agreed upon with the seller gets folded into closing costs along with lender fees. By the way, one of your benefits that you receive as a Gaucho alum in our partnership with APM is you get discounted closing costs with us as well too. So that's a really cool benefit. But on a conventional loan in standard, you would generally need about $35,000 to $42,000 out of pocket to purchase on a conventional loan. That can be a bit of a stretch for some of our first-time buyers. And so where the CalHFA program is a really great fit is that you can get My Home, let's say up to $21,000 in assistance on that purchase to reduce down your out-of-pocket. If you still need additional resources, you could tap into the ZIP Assistance Program. The ZIP Assistance Program that would also provide another 2% in loan amount assistance. So, when I think about that conventional home purchase, I might not have to put that $35,000 to $42,000 out of pocket. Maybe it's less. Maybe it's $10,000. Maybe it's $20,000. And for many of our first time buyers that I get a chance to work with across the market, that can make the difference in reaching towards homeownership this year versus 2, 3, maybe 4 years down the road. In fact, I mentioned this to Liz earlier. One of your fellow Gaucho alum purchased using the CalHFA program just last month. They purchased a beautiful townhouse in Ventura. Happy homeowners and graduates of our class in 2024 here in our workshop. So it can certainly happen with tools and resources like CalHFA brings to the table. Now, there are minimum credit score requirements. Minimum credit score on the FHA loan is 640. It's 660 on a conventional loan for a low income housing buyer, 680 for a moderate income housing buyer. We learned a little bit about debt to income ratio tonight. So it's 45 to 50%. One of the unique attributes of this program is we only look at applicant income, not household income, like a lot of programs do. So you may just include, say, your income just as the applicant and not include your partner's. That could keep you within the income limits of the program. And a first time buyer is someone that hasn't owned a primary residence in the last 3 years. So that's a little bit of a unique thing about this program as well. It's eligible for essentially all one unit properties. So single family homes, townhouses, condos, manufactured homes, BMR homes, which would be a below market home, and manufactured homes that are on land that is owned. All right. I mentioned a little bit about the income limits. They're 150% of the median income for your market that you're going to buy in. You can see those limits here. So we've seen some uptick in the income limits, which is really no surprise given the cost of housing and or wages, I should say, as it relates to expenses. But those are the limits as we see across the Southern California markets. All right. If you're in a different market, we'll get you those income limits for you to check out as well. All right. As we wrap up tonight's class, I appreciate everybody kind of hanging in there because I think going through this buying process and understanding what comes next is a really important part of tonight's class. This is our 6 steps of home buying. And you mentioned to me the success story of one of your fellow Gaucho alum that purchased last month utilizing the benefits of a first-time buyer programs. This is how that process went for them. So after leaving tonight's class, they were pre-approved for their home purchase. And so that is step 1 in our 6 steps of home buying. A pre-approval essentially showing that you've been validated in your finances, that you're eligible for home financing. And that's the output of a consultation with me, which is a service that we provide to our clients to prepare them for home ownership. A pre-approval is good for 60 days, but it's no like time sensitive thing where I have to run out and buy a home right away. Your application with us that only starts with a soft credit check is good for 2 years. So there's really no rush to go out and buy, but a pre-approval validates all your financials. So if you do identify a home that you want to present an offer on, your pre-approval kind of supports all of the important things that the seller wants to see. Now, step 2 is house hunting. That generally starts online and then it'll transition to in-person once you've identified a few homes that you want to target. Now, in today's market, there's a lot more inventory available to you to check out, but it'll generally start in some of the sites that you're all familiar with, Zillow and Redfin, and checking out some of those sites. And then we would encourage you to partner with a local realtor that's an expert in your market. Now, since we focus a lot on first-time buyers, we have a preferred realtor network that we can introduce you to a realtor that can help support you in the buying process. But we would encourage you to connect with a realtor that can be, an expert in the market, but really an expert in negotiations and has good partners that work alongside them. So you can have the best of inspectors that are checking out your home once ever you find the home that really works for you. Now, as we move through the process, you'll eventually submit an offer to a home. It might not be accepted the first time, but maybe on the second or third time. But when that offer does get accepted, then you move to step 3. That's called entering escrow. That means you have a ratified contract with a seller and it starts the escrow process. Now, traditionally in California, the escrow process is 30 days. So to go from accepted offer to getting the keys to your house, it takes about 30 days, but it can be shorter. It can be as short as 14 days. As the escrow process starts, you have actionable things that you do as a buyer, like making an earnest money deposit into the escrow account to show good faith in the transaction. That usually is done in the first 1 to 2 days. Now, within the first 24 hours of your accepted offer, you're going to get a call from me saying, congratulations, you did it. You have an accepted offer. It's really kind of a huge step in the right direction when you get that accepted offer. So we want to kind of celebrate that with you, but then also talk a little bit about next steps. I meet with every client for a follow-up video session after they're in escrow to make sure that all of the design work of their financing is set up properly and then start us through the ensuing milestones. Now, in a real estate contract, you do have contingency periods that protect you as a buyer, which is really important. Those timeframes of contingencies can be anywhere from 7 days to as long as 17 days. That allows you to get your house appraised to make sure the value is supporting the purchase price. You want to have inspections done to make sure you check out all the elements of the property. And you want to have your loan approved to make sure the loan is meeting all the guidelines and that your financing is fully in place. As we move through the different milestones, we takes us to step 4. Step 4 is going to be the processing and underwriting of the loan. That is more the administrative function. That's verifying your employment, making sure your income is set up in the system properly, make sure the product matches correctly. It'll also probably include locking in your interest rate. Interest rates vary over the course of the trading day, but when you're in that process under contract with the seller, then we're going to strategically talk a little bit about the timeline of locking in interest rates. So interest rates improved a little bit today, so we were able to kind of time the market for our buyers because they're now under contract and able to lock them in at the lowest available interest rate that we can offer. Step 5 is going to take us to loan approval. That's where we issue the final underwriting approval. That takes us to about 3/4 of the way through the process. Now, as you move through every milestone in our process, you're receiving electronic disclosures with updates on your loan. At step 5, we're going to be putting the finishing touches on your financing. That includes delivering a final closing disclosure to you, which gives you a 3-day cooling off period before we get to the final milestone. And that's the finish line. That's the closing of the loan. That's when you do have to make an in-person appearance for signing of your final loan documents and escrow documents. That generally takes about an hour or so. It's usually done a couple days prior to getting the keys to your house. But after that work is done, we're going to wire in the final funds for the closing of your home loan. You've probably contributed the final funds that you owe for the transaction. That money gets reconciled with an escrow team, and then documents get recorded with the local county recorder's office. They record a grant deed to transfer ownership to you as well as the deed for the home loan. And guess what? Once that stuff gets all confirmed with, the Ventura County Recorder's Office or LA County, wherever you're going to buy, then we get confirmation of that. I get a chance to make my favorite call of the day, which is to say, hey, congratulations, you're now a homeowner, which is a huge accomplishment. I get to do that like 2 or 3 times a day. It's the favorite part of my day, next to teaching one of our classes at night for one of our partnerships. But it's a huge accomplishment, right? It's really to say, hey, I now have this huge opportunity with a new asset that's probably going to create generational wealth for myself and my family. So huge accomplishment. Again, we've got a chance to help several gauchos just a gaucho just last month that just attended one of these classes. You too can have the opportunity to pursue home ownership, and we'd love to be a partner for you on that journey. Here's what our next steps look like if you do want to get connected with us for a consultation. It is a free service we provide. It's a really simple 3-step process. You complete an online application, you upload proof of your income and assets, then you use our scheduling system to book your appointment time. I meet with all of our clients that attend our classes. I do a 30 minutes free session with them just to help create a path towards homeownership. Whether you're going to buy this year or next year, we just want to make sure you have all the tools and resources to make a great financial decision. All right. I want to take a question. I'm just kind of wrap up here, but we do have a question in the chat. Actually, let me just save that question and we'll take it to our end of the session tonight. But here's what a consultation looks like. Again, that's a free service we provide to you. We're going to do some budgeting exercise, understand a little bit more about credit, design some different programs for you. So that's kind of what that's going to look like. I did want to point out our mobile resources. So we obviously understand the power of the human touch in the process. And so we want to make sure we stay connected with you. But we also leverage technology. So you'll see a lot of work that we do on mobile. We're always available by text, of course, calls and emails and whatnot. But our mobile tools can be a great resource for you as well. I spotlighted our discount program that we have with UCSB alum and our partnership with APM. So we discount our services in partnership, not only just providing these, I think, pretty informative classes, but also providing you some discounted resources when you decide to take that next step in homeownership. We also have other classes that I teach throughout the country. So if you have friends, family, maybe some coworkers that you think might benefit from some of our classes, we teach over 60 classes per year. So they're always free to the public. So you can have them kind of check out one of these live classes. And of course, every class that we've taught over the last 8 years is up on our YouTube channel. All right, here's all my contact information. So if you do want to have any follow-up with me, feel free to reach out to me. Of course, you can book a consultation. We'd love to be able to make that happen for you as well. We're here to be a partner for you on this path towards homeownership whenever that time is right for you financially. And here's all our social links here so you can kind of check out what we have as resources for you as well. I do want to take a few questions. I know a lot of you hanging out in the session, so I do appreciate that. We're right at the top of the hour. I was scrambling to get all that information to you guys. Let me answer one of our questions that came in, which is when should we start applying for assistance programs? If I want to buy next year, when do you suggest? And also, how can I apply for teacher assistance programs and state assistance programs? Okay, great question. So when you work with a lender like us, who is a preferred first-time buyer lender, we get you connected with the programs as we build your home buying plan. So, as I meet with you, as you submit your application, we're going to figure out which products are the best match for you. And then ultimately what happens with first-time buyer programs like the CalHFA program, once you go into contract with the seller, then we register you for the programs. Okay, so that's kind of how that works. So I don't think it's ever too early to complete your application and get connected with us. Like I said, whether it's a year or 2 years down the road, I met with a couple today that's going to buy in the San Diego market that's not planning on buying until next June, right? But they want to kind of get their financial house in order. And so that's why they connected with us. All right. One thing I didn't mention on the CalHFA program, and since we have a lot of you still tuning in, you guys may have heard about the Dream for All program. If you've heard about that program, we were provided the most number of resources out there in that program, and that program may come back online in the following years. It looks like there's about $300 million carved out in the new state budget to support that program in the future. We don't talk about it in our classes today, but we have in the past. And if that does come back online, we'll certainly share that more back with our online community. But ultimately, that program provided up to 20% or $150,000 in assistance. It is a shared appreciation program. It may have some augmentation to that. We'll have to see what happens. But in case you do hear that in the news, it looks like that was carved out into the new state budget. So we'll get more details out to our community as we hear that. Okay. Any other questions from our group? You guys have been super attentive. Great questions. I do appreciate that. Thank you for the feedback there. I do appreciate that. Okay. I think we're good. Well, I wish you guys have a wonderful summer. Hopefully you're enjoying the summer wherever you're at in the market. And we'd love to be able to get connected with you at some point. Feel free to reach out to me anytime. Love to be able to help you in making this financial decision. All right. Have a wonderful night. We'll see you soon.